Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York on Tuesday, the 18th day of March 2014, and this is the daily report for gold and silver. We do have downside pressure in the marketplace today with the precious metals trading lower across the board. First to gold, 1355.50. That's the current print you see on the screen. Puts it off around $12 on the day with the low 1350.70, the high 1365.70. Of course, we did trail our stops. We pulled profits at 1358 this morning, in at 33, out at 58. We'll talk about that in a little bit. Silver also trading lower this morning, the low 2057, the high 2123. Current print 2081. We moved our stop to 2090. We did get knocked out of that trade with a small loss. First, to gold this morning, we are looking at a 480-minute chart, standard candlestick format. And if you recall from yesterday's show, we talked about the fact that what we saw when we took a look at this most recent top in the market was a couple of candlestick factors that really brought our attention, and that's really what caused me on a technical basis really to trail our stop up. And what I was looking at is as follows. Let me go ahead and pull my arrow up. And there were a couple of things that we talked about. One of the things that we talked about were these couple of dojis, and we specifically pointed out this doji right at the top because although it's a doji, it's almost shooting star-like. And we talked about the fact, even though it has that small tail at the bottom, you can see that the upper tail is at least 3 times the size of the body. And that's what predicates a shooting star in terms of identification in the marketplace itself. Let's go ahead and blow this up a little bit, and you can really see what we're talking about. This one candle right in here. And that came right after this doji. We also talked about the fact that when we looked at these 4 candles right in here, 1, 2, 3, 4, we really saw a pattern that is a variation off of a 3-river evening star. And technically, you tend to see this type of formation at a pivot point. That is what really caused us to dramatically move our stop up. Of course, we got in first at 1258. We got out, I believe, at 1325. We then re-entered the market at 33 right in here, and then got out right here at 58. So when we consider the fact that this market has moved roughly, call it a $200 from 1181 up above 1381, we were able to pull about $90 out of that. So about 50%, a little bit shy of 50% of the entire move. I'm more than satisfied with that because that really, when we look at it, is about 100% return on these last 2 trades. And I never really believe that we can buy the bottom and sell the top. I also believe that as trend traders, and by trend traders, I mean we're effectively trailing our stop up as the market moves. If it's moving within our favor, we consistently move up, trail these stops up higher. When we do that, of course, what we give up is trying to find the top of the market and to get out at the top of the market. But what we gain is when we have these sizable moves, we're able to gain and get a decent percentage of that move. And that's all we're looking to do, is to get a percentage of that move and to protect the equity when we're incorrect, and to maximize what we can get out of it when we are correct. So all in all, I feel fairly solid about the trade. Now, where is this market going to go from here? Well, that's going to be the discussion right now, because you can see that it hit this bottom at 1350. It's now beginning to move back up. But my belief is that we could be looking at a counter wave to this last rally up, and in that we would see a little bit more downside. We'll talk about that in a second. So traders, what I've done is I've pulled up a daily chart, and we put this chart up yesterday, and what we're really looking at on this chart is we're looking at this last rally. This is really January beginning 2014. The market rallies pretty much straight up. We had a move that as I said, started 1183 is where I've got the bottom here. I'm putting our top here at 1390, and when we look at this collective move, we talked about this yesterday, we have a couple of different levels we could see this market fall to, although my personal belief right now is we will not see a 50% or a 61% retracement. We could easily see a 23% retracement. That would take us to about 1341, 1311. That would be the lowest I think this market could go, but my sense is we probably won't see it go down there either. But the key is this: when we look at this particular move up, we have to realize and look at the different fib levels, 1341.90 and 1311. Those are the areas that I would probably look for this market to possibly move down to. We'll have to see, because when you get this type of action, and when I mean this type of action, we've had a dramatic rise in this marketplace. It's moved $200. It's done that in a couple of months. You sometimes only get the market kind of consolidating, moving sideways and a little bit lower, but in terms of a straight model, this is the area that I'm going to look at, which is 1341, 1342. Now, before we take a look at our chart that contains the Andrews pitchfork, because I think you're going to find that to be extremely revealing, rather than breaking through, in essence, what it did was go to the top of the channel and then back down. I draw your attention to this long-standing resistance line that we broke. And the reason I'm drawing your attention to this is realize that when it broke really above this, it didn't do it in a very, very clean, dynamic manner. In fact, what we saw was the market kind of trading around this area before it actually broke through and started trading above. And then the resulting rally that came was this here. The reason I bring that up right now is because you're going to find when we look at this channel chart, the Andrews pitchfork, we came right to that channel and backed off. Let's go ahead and pull that off. Now, of course, I will compress this in a second, but I did want to really enlarge this. Let's go ahead and enlarge it as much as I can and then kind of bring it up. You can see that without a question, when we look at this channel, the close of the market came right to this line. We did get a high that came above this line, and that to me is what is simply called a scouting party. It is a pattern that we've talked about in the past. It's not a candlestick pattern, but the term was coined by Steve Nissan, and the belief is that as the market comes up and goes to make new highs, the bullish faction will kind of pull the market up to test the fortitude of the bears to see if sell orders come in. If in fact they do, it's going to bring it back down. And it might take a couple of times before we actually see that channel broken, if at all. But here's the key. Let's go ahead and compress that chart so we can look at it in a more normal manner. And we've done just that. So now we can see, you know, that the handle itself comes from that 1900. We don't really need to put that into the chart, but here's the key right now. For us to have the technical evidence that we need, that we have absolutely broken out of a bear trend, we need to see this market break above this at some point, because as long as it is within this channel, as we talked about the other day, we could witness the market simply moving from the bottom of the channel to the top, back to the bottom. But when we look at it overall, the price is still lower. In other words, we're in a bearish trend, and it has this dynamic range, this channel that it's within. It's really critical on a technical basis that it does break above this. Now, also realize that this is the first time we have tested the upper levels of this, call it this, the outer prong, the zero prong on the Andrews pitchfork, since this market started trading lower at 1800. And so this, to me, is still a real bullish factor, because we have dynamically seen it come up to this. But the fact that it's backed off like this, my sense is that as long as it backs off, it still has the ability to move in. But we really don't want to see it start trading much lower and into this channel, because what that does is it negates the evidence that we need in terms of looking at this as a bullish rally as opposed to a bullish counter trend to a bearish market. And there's no doubt we've seen the market go from 1800 to 1181, come to 1435, back to 1181, and then boom, it comes up to about 1400. So we are now looking at a market in place in which we have this double bottom here. And of course, it's a little bit harder to see because you have these cascading lines, but we know that we've got a double bottom there. And we've also now are close to having a double top, although it came shy, this being 1435 here and 1390 here. So we're what, about $45 shy of that top. My sense though, traders, is we will probably take another stab at breaking through this point. The question is, are we going to get a softening in the market? Are we going to get a correction? Will that correction come as low as the 23% on a channel and then move back up and then break through? I don't know. We'll have to see how it unfolds. However, I'm still interim term bullish, long term bullish, short term I am bearish to neutral, believing that we could see a little bit of profit taking continue in the marketplace itself. So how does that affect our long-term view of the market? Well, as I said, I'm still bullish interim as well as long-term. And when we look at this marketplace itself, we realize this is our long 9-day chart. But we realize when we look at this chart, let's go ahead and kind of blow that up a little bit. We've had a series of green candles. You've got the small-bodied candle. It's also very, very shooting star-like. As I said, I wouldn't be surprised to see this market maybe backfill to about 1340 or so. If it backfills to there, we find support. That's going to be our re-entry point. Now, in terms of my current outlook on silver, I cannot say that I'm bullish in the same way long term that I am with gold. And the key in terms of a technical basis is the fact that we've really never seen the same kind of rally as gold was rallying to higher prices starting at the beginning of 2014. You can see that right here. Silver really traded sideways. We then got that nice spurt in silver, kind of faked, I think, a lot of people out, but it failed really to be able to breach or to take out this long-standing resistance line that we are able to draw from these tops here at 50 and then carry them through to these series of tops starting at about 35 going down to about $32. We've stalled here, and as you can see on this weekly chart, this of course is in Japanese average format. However, you've gotten these really, really small bodied candles. So for that reason, I'm neutral to bearish on silver, short term, neutral, interim term, as opposed to gold, where interim term I'm extremely bullish in gold, and long term I am bullish on gold. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.